My recent video on the 30-year front load trick caused a lot of noise in the comments, with several people claiming the math is false or misleading. Today we're setting the record straight using standard banking mechanics. Take a look at this graphic. This is a visual representation of a 30-year amortized loan. The yellow bars represent the volume of your monthly payment going straight to bank interest. The green bars represent the sliver going toward your actual principal balance. The red line represents your total principal balance over 3 decades. Now, some great analytical minds in the comments pointed out that the stated annual interest rate on a mortgage stays exactly the same, say 7%, and that the bank isn't arbitrarily changing your rate on day one. You are completely right, and I appreciate you bringing that clarity to the discussion. Strictly speaking, a standard loan isn't front-loaded arbitrarily. Rather, interest is calculated on the remaining balance. But because your balance is at its absolute highest in the first 7 to 10 years, the sheer volume of dollars going to interest overhead is massive compared to the tiny sliver going to your principal. If you look at your very first payments, you might be handing the bank over $2,500, but your actual debt balance only drops by $300. You are spending multiple times more on interest volume than you are gaining in true equity. So while the nominal rate on paper is technically 7% on a yearly basis, the time-adjusted cost of borrowing and the structural friction on your cash flow is incredibly high. You pay a vast amount of interest in the early years simply because the outstanding principal remains so high for so long. The math isn't broken, it's just hidden from view. Many of us were taught to only look at the interest rate, so it's completely natural to miss how the structural layout of a standard amortization schedule actually moves our money. It isn't your fault for not seeing it, it's simply how the system was designed. If you sell or refinance within that first decade, which statistically many homeowners do, you've handed the bank the majority of their profit while barely building any true equity for yourself. Once you see how the interest volume is stacked, you can finally stop looking at static rates and start making choices that serve your balance sheet instead of the lender's. That's why understanding these mechanics changes everything. Send me a message or click the link in my bio to receive our framework on breaking out of the amortization trap.